You're 69 years old, single, and retired, and you've accumulated $1.6 million in your 401k. The question becomes, is now a time to move some of this 401k money to a Roth? That's what we're going to look at in our time today. Hello, my name is John Vandergriff. I'm one of the owners and wealth planning team lead here at Blue Ridge Wealth Planners, where we help people transition into retirement with planning in multiple areas and making sure that if we meet people that are already in retirement, that the planning reflects the phase of life that they're in, that they're currently experiencing. And so one of those areas that often gets overlooked or missed or never talked about is the realm of tax planning. And so that's where we want to spend our time today and see not only the decisions need to be made in that bucket, but also the impact that those could have in other areas. So again, 69, single and retired, 1.6 million in your 401k. That's the situation we're going to be looking at today. And as we always do, we want to point out that taxes are a very important piece, but they are only one piece of a well-rounded plan. We need to focus on more, especially in the tax decisions we're making, but also see the income impacts. We do need to factor taxes into the way we invest money, healthcare, family legacy. All these things come together and need to be moving in the right direction for you as an individual before ultimately we get into a situation where we may be missing something that can make a major difference for your situation. So what we have today, a situation, single person, age 69, their Social Security at age 70 would be $4,300 a month. They are currently taking a pension of $4,000 a month, and so their income need is $96,000 a year, $8,000 a month. Once this person gets to Social Security, they're going to be good from an income perspective. They'll have a little bit of a need now. And so again, kind of choosing how we take that income will be part of the conversation, but then seeing if we can maximize some of these tax decisions. And so with that being said, I always like to point this out at the beginning of our videos. We're about to do some things that are specific for this situation. I would caution you not to act just on these things. You need to be talking with your CPA, have someone who does deal in tax planning walk you through how these things could impact you as an individual. If you've not had that opportunity, you can see a link below where you could talk to our team here at Blue Ridge Wealth. We'd be happy to walk through those discussions with you. But I always like to throw that word of caution out before we get into kind of the particulars of movement and decisions in this particular vein. So one thing we need to know about Roth conversions, moving money out of an IRA or 401k is a taxable event. And again, most of the time people don't have Roth 401k options, so you may need to do a rollover into an IRA, which is a tax-free movement, but then the money coming out of the IRA to the Roth is taxable. So we'll look at that example here. Roth IRA needs to be in place for 5 years before you have completely tax-free distributions. You have tax-free growth while it is inside the account. If over 59 and a half, when you make that conversion happen, the principal is actually available to you during that 5-year period that you're waiting, but the growth would be taxable if you liquidated the entire account or took more than what you converted. All right, so with that being said, let's zoom in here. So we've got a person who needs $96,000 of income. This is where their income will be at next year. So again, income needs will be covered. $48,000 of income cash flow coming in right now, which means $48,000 of taxable income. For a single person, this would put them at the top bracket of 12%, which is important because that's going to be where any type of money coming out of a retirement account would be taxed at. So we've got $1.6 million of pre-tax money, $350,000 of after-tax, and $0 currently in tax-free positions like a Roth account or a properly structured life insurance plan that can offer tax-free growth and tax-free withdrawal, very similar to a Roth IRA. So as we look at this, the baseline decision that we want to focus on in our video as we start here is just simply, does this movement make sense for this particular individual or you as an individual? Because again, this is something where when we hear the words tax-free, we think, oh, we definitely need that. not every situation benefits from moving money from a taxable to tax-free, so we've got to look at the particulars here. And so this is an example that we use all the time. It is more for education purposes than anything. At the end of our time, we're going to look at some specific recommendations of conversion, but very simply, what we're going to look at is if we have $100,000 of 401k, what happens if we leave it alone versus if we migrate that money over here to a Roth account. What changes? Is that a good decision? Well, again, we're going to play out the scenarios here. So leaving money in a 401k doesn't do anything from a tax perspective because these accounts will continue to grow tax deferred. So you've got $100,000 there. As we said, you take that $100,000 out, add it on top of the $48,000 of income, you've got $148,000 to pay tax on. And just for round number's sake, we'll look at the effective tax rates later. Let's say 20% is the tax bite, and you pay that out of these monies for a fair example. Truth is, you could pay this out of after-tax money and have more money grow or go into the Roth. But just so this is a fair comparison, we're looking at $80,000 to start the Roth versus $100,000 in the 401k. And when I've talked to many financial advisors, they will use this as a basis for why someone does not need to do a Roth conversion. They'll say if the market goes up, this side will make more money than this side, which from a math perspective is true, but we're not looking at the same growth. If we grow 10% here, this is a taxable 10 versus a tax-free 10. And again, depending on the tax rate when we come out, we'll determine which one was ultimately a better decision. So as we said, we want this to be a discussion about taxes, really only, not investment decisions or inflation. So let's assume that both of these buckets are invested the same way for the same length of time. And for the Roth rules, let's assume it's longer than 5 years to double this money, which in most cases will probably be the case. So we've got $160,000 in the Roth position. We've got $200,000 in the 401k. Now we go to take this money out, and as we said, as long as this has been in place for 5 years, you've got this full $160,000 at your disposal for whatever purpose you want to use it for. The 401k, it depends on the tax environment at the time you take your distribution. And you may say, well, John, my plan is never to take money from this. Well, you're going to be forced to take this money out once you reach RMD age. This person is 69. They have 4 years now before they are forced to take it out. And so let's say at that time the tax window for them is the same as it is at the top here. What you will find is that the bottom line number is exactly the same. $160,000 versus $160,000 because the cost to leave the account in both of these situations was exactly the same. So as we look at this, what we have to recognize in this particular situation is this kind of goes against a lot of the way that people have recommended tax decisions go when it comes to retirement, because most people believe if you show a lower income, you will pay a lower tax. Makes sense. However, that's not always been the case. We have had in our country's history times where even adjusted for inflation, lower dollars of income would have a higher tax percentage owed. But if we look at this, traditional advice, and let's say 12% is the tax rate instead of 20%, you have more money at the end of the day leaving it in the 401k than you do making any kind of conversion, because the cost to leave now is higher than the cost to leave later. So that's the thing that we've got to look at, but we do have to reckon some current events into this to see if this is a good decision, because what's happening in Washington right now is overspending in a large degree on an annual basis, and years of that has caused us to accumulate over $31 trillion in debt. It's growing by the second, and really no kind of solutions out there of how to fix it except to look at the past and see what we did in the past, which was increase taxes substantially. So if that is the case and taxes go up, then paying the lowest tax environment may lend you to make that decision right now. So we've got to recognize that this is something that matters, because every dollar that's in your 401k is 100% exposed to the decisions that you are looking at and really the decisions that the government makes when it comes to income taxes. So let's see what the impact is of tax changes now. So we've got 2023 here, single rate. So as we said, with the $48,000 of income that they're showing this year puts them into the 12% brackets when we have standard deductions factored in. And so we've got to see how that compares to later. So again, as we look at this, the reason why I marked this, so this is 2017's tax brackets. If nothing changes, those will be the brackets that go into effect in the year 2026. And so as you notice, the $48,000 goes into the 15% bracket now instead of the 12%, which you may look at this and say 3% doesn't sound like a big increase. Well, for every $100,000 of money that you have, that's an additional $3,000 of taxes that you would be paying as things continue to progress. So that's if it stopped there. But we've got to throw in a situation where taxes look different than what we've gotten used to. In 1981, the tax brackets themselves were much larger than they are at what we've gotten used to. We compare the bottom number here of 70% to 39.6 and also 37% the way they are today. So almost a doubling of taxes, and this isn't even the highest tax environment that we've been at. But you notice here that they are at 19%, which is an increase, not quite a doubling. But as we continue to progress through income, when we add Social Security and then RMDs to this, we start to have a much larger picture that we have to pay attention to. So again, one of the things that we've got to point out with people is really the impact of RMDs on their retirement. Because most of the time people think, oh, my income's going to be less. It may or may not, depending on how well you've done in saving and how little of that money you need. So as we said, we're showing a 5% growth on this, no contributions. We're going to show based on this that they would actually fund their lifestyle from the after-tax money that they have so that they can maximize the conversions that they can do in this tax year, especially before Social Security starts. So if we did that for 4 years, 5% growth, that would increase the bucket to just under $2 million, and the RMD needed at that time would be $73,000 on top of their Social Security and pension. So as we look at this projection here, we see that today income is $48,000. So we see the 12%, 15, and 18 would be the top brackets that they would come to in the scenarios we looked at. But next year, when they add Social Security to the equation, the taxable portion is $91,000 and change. That jumps this particular situation to a 22, 25, or 34%, depending on, again, what happens with tax brackets in the future. Then when we add that $73,000 of RMD to the equation, this single person has $164,000 of income that they have to show whether they need it or not. That doesn't jump as much tax bracket today because of the way the brackets are positioned. But again, you go somewhere between 25 and 28 and then 34 to 49%, which is almost half of the money that you take out in distributions as a tax, which is not where anybody wants to be at. So question becomes how much to convert. I think totally makes sense to max out the 12% bracket, also the 22% bracket with where they are today, and then potentially going into the 24%. If we maxed it out, that would be the total $86,725. The total together would be just under $148,000. And if we look at the taxes only, the effective rate on that would be 22.5%. But we do have to add in the effects of Medicare to this equation because, again, anytime we go above $97,000 of taxable income, this is your baseline cost for Medicare. It would increase as you go through these thresholds. Adding the $147,000 to $48,000 of taxable income would push you into this bracket, which would be an additional, $5,100 of taxes in effect. It's not really taxes, just increased costs on Medicare, but that would go into effect 2 years from now. So again, if you add that in to the total cost here, 25.9% is what it costs to actually do this. Some of this is a future cost, but still you need to factor that into the equation. And when we look back here, I think compared to where we're going to be in the future with some of these brackets and with the income levels that we're going to have in the future, I think that could still make a lot of sense, even though that's an additional cost. So, you may be in the position today where you really haven't had these type of conversations. If that is the case, you're probably not going to have it with who you're working with now. You know, when we sit down with somebody for the first time, we are having this discussion. So we would love to share that with you. You see a link below this video. I would encourage you to click that, schedule a time with one of our wealth planners, see if the things we're talking about here could be a match for you in your situation. Because again, like we said, we may work hand in hand with your tax professionals, making sure we have all the information we can get so that we can put you in the best position with taxes in the future. And especially if you're close to this situation where you're going to have a staggering up of income when you have Social Security and RMDs, now may be the best window of time to pay taxes that you get again. And so we don't want you to miss that window. So thank you for joining us today. Hopefully you like this content that we went through. Be sure that you like and subscribe to our page so that you get more of it. Share this with somebody else, or if you have some feedback, we'd be happy to get those in the comments. So we look forward to sharing more content with you, and we'll see you next time.